Good morning and welcome to the first in a series of currency workshops that we'll be running in conjunction with Board BIA. The purpose of these workshops is to upskill clients in the area of foreign currency management and hopefully to help them in volatile markets, in particular in relation to the markets that exist around Brexit right now. My name is John Finn. I'm a chartered accountant. I'm Managing Director of Treasury Solutions Limited, which is a company that works with corporates in dealing with their banks and risk management. I have 27 years experience in this area of debt and financial markets. I'm a fellow of the Association of Corporate Treasurers and a member of the Irish Association of Corporate Treasurers as well. So basically this is what I've done for the last 27 years, and hopefully over the next couple of weeks we're going to get a chance to impart a lot of information in this space to you to help you manage your currency risks. We've got 5 objectives here that we hope to achieve as part of these workshops. The first is starting literally at the basics, as it says here, to make sure that everybody understands foreign exchange basics. And as we say here, FX is shorthand for foreign exchange, and you will see FX come up in a lot of the slides. So that's what it means. Moving on from the basics, we want people to understand what the different techniques are for hedging foreign exchange and what their use is. We will then move on to how you develop a policy for your own company. What's your policy about hedging? How far forward you hedge? Governing really the risks and controls around that sort of stuff, and then develop that further into a strategy. So you're selling into the UK or you're buying from the UK. How do you develop a strategy that makes sense for your business, and that marries the currency risks with commercial risks that you have? And we will then also cover the wider impact that foreign currency moves can have on financial and banking metrics. So while we're always preoccupied with the impact of currency movements on our sales or our purchases, it actually has an impact on other areas of banking and finance as well. So we will cover that off. So starting with the basic foreign exchange hedging techniques, we will cover spot transactions, forward contracts, options, and vanilla just means plain options, so nothing very sophisticated or too fancy. Options in their own right are a bit complex, but we'll talk about them in a second. We will then look at a variation of that which are called collars. They're also referred to as ranges or cylinders. We will deal with participating forwards. And for the purposes of the examples here, I'm assuming in this case that the customer is selling sterling to banks because they've got UK sales. So they're getting sterling into their bank accounts. They want to sell that for euros because they have most of their costs in the Eurozone or in the euro itself. In a scenario where somebody might be purchasing from the UK, obviously it's the same principles, same techniques, but the logic is the other way around because you're exposed to rates moving a different way to sellers, but it's the same principles. So starting with foreign exchange spot, the spot rate is the rate that is currently available today. So in other words, we want to do a deal today, we ring a bank today and say we have X amount of sterling that we want to sell. Standard market practice is that there's a 2-day business cycle for these transactions. In other words, we ring the bank today, we actually do the deal today, we agree the rate today, but the delivery of the currency is in 2 days' time. So in this scenario, if we're selling sterling, we're selling sterling to the bank in 2 days' time, and they're selling us the euros in return for that in 2 days' time. Now it is possible to transact these on a same-day basis value. In other words, I need the money in today. So it is possible to actually do a deal today, Monday, with a bank where I get the funds in today, Monday, and pay those funds out also today. But you would have to specify that when doing the deal with the bank at that time, because market convention is a 2-day lag. The idea of spot rates is that they permit a lot of flexibility. So when you're either not sure when currency is going to come in or the final amount that's going to come in, spot transactions are most suited for that because they allow you effectively to fill the gap where you're not quite sure of as I said, of either the quantum or the amount. So obviously the spot rate on the day that you sell your currency could be better or worse than the rate on which the sales were made, or similarly the same for purchases. So there is a risk as such, and it's not a hedging product as such, because you may decide to sell something to somebody on the 1st of November. You look at the exchange rate on the 1st of November, and that dictates the price that you charge them in sterling. But if you get that money in on the 1st of December, then the exchange rate could be better or worse. So as I've said, it's useful for what I would say is plugging the gap, but it's not a hedging product as such, because the rate could be better or could be worse than the rate that you used to enter into the transaction in the first instance. If you move on then to forward foreign exchange contracts, basically what we do under those is we agree a rate today that applies to a future delivery date. So taking the example that I gave you a minute ago, we have a sales order that we're entering into and agreeing today on the 1st of November. We're going to be paid for that on the 1st of December. We don't want to take a risk on the movement in the exchange rate over the month of November. So what we can do basically is we can agree a rate today that will apply to the 1st of December. We can really look, how far forward can you go? Well, a forward really can be from 3 days out to potentially up to 3 years. Now, the average in the market, most banks will allow companies to deal 6 to 12 months forward. If you want something more than 12 months forward, it's something that you certainly would have to agree with a bank, and it's not something that they do routinely. So that would be an exception. But is it possible? Yes, it is. The forward rate then, which is the rate that they charge you, it's a combination of the spot rate that we covered off 2 minutes ago and something called the forward points. Now, the forward points are not a charge by a bank. They're basically the difference in interest rates of the two currencies. So all it really means is that the rate that they charge you for delivery on a future date is today's spot rate on the 1st of November, in my example, plus a number of pips, plus or minus, I should say, a number of pips, which gets you to a transaction date of the 1st of December. The beauty and the advantage, I guess, of forward contracts is that they bring certainty. So we can agree a rate on the 1st of November that kicks in on the 1st of December, and we don't have to worry about where the exchange rate goes in the intervening period. Now, the obvious advantage is that not only do they give you certainty, but they protect you against the rate moving against you. So in the case of somebody who's selling sterling, let's say the spot rate on the 1st of November was 88 pence, you don't want the currency going to 89 or 90 because you get less euros. So what it does is it protects you in that scenario. So should sterling move to 90p over the month of November, you're still selling your sterling at 88p and you're protected. The flip side of it, of course, is that they don't permit a favourable movement. So in a scenario where sterling moves back up to, say, 86p, or down, I should say, to 86p, sterling gets stronger, in that scenario, you will not benefit from it. You are stuck, for the want of a better way of putting it, at selling your sterling to the bank at 88 pence. But as I said, most importantly, what it does is it gives you certainty, and you know on the day that you make the sale or the purchase exactly how much the sterling is going to cost you or how much you're going to get in a month's time. If we move on then to options. Now, this is a very quick run through, and options, to be honest with you, I'm putting them in for information's sake at this point of time, but if it's something you're interested in looking at, you would have to get better or more detailed independent advice, because they're a little bit different and you need to know exactly what you're doing in this space. But it's important to let you know that these products are out there. Basically, an option is an insurance product, and what it means is that you're buying, think about it, you buy insurance. You should never sell insurance, so you should never sell options on the face of it, because you want to be insured against something going wrong. And there is a little bit of jargon here. So a put is the right to sell something and the call is the right to buy. So in this scenario, if I have sterling that I want to sell to the bank, obviously I want to have a sterling put, I'm selling sterling to them, and that would be a euro call. I'm buying euros from them. So that's what the jargon is. Again, it's just so that you understand what it is. So as I said here, for UK exporters with sterling to sell, it's a sterling put, euro call option. And that means that the customer lodges sterling into your bank account and you want to sell the sterling to the bank. The next thing that you need to understand is there's a concept called at the money. What does at the money mean? At the money basically means that you're buying the insurance at the current foreign exchange rate. So at the current spot rate in effect, or the rate that you could transact at today. You can, of course, buy insurance out of the money, which means that you're buying it at a rate worse than the current spot rates. And why would you do this? Well, I guess at the money basically means that if sterling's at 88 pence today, I want the option to be able to sell sterling at 88p in a month's time. If I'm fairly comfortable that sterling is not going to weaken, and in actual fact, I think, look, the probability is it'll stay where it is, I could actually buy insurance at 90p rather than 88p. And the reason why I might buy it is because it's cheaper to buy insurance at 90p rather than 88p. So there are three things I probably should have said on the pricing of options. What would it cost? The first thing is, am I buying it at the spot rate, at the money, or am I buying it out of the money? Out of the money costs less than at the money. Second thing is, how far forward do I need to buy it for? An option for 3 months will cost more than an option for 1 month, but it won't cost 3 times the amount, but it will cost more. And the third thing that drives options pricing is volatility. In other words, the more volatile the currency, the more expensive an option will be. The other disadvantage that people perceive about options is that because it's insurance premium that you pay that up front. So that means you've got to write a check or make a transfer for the amount on day one that you buy the insurance. But it's the same as insuring your car or your house. You pay the premium up front and it covers you then for 6 or 12 months thereafter. And options are the very same. But the beauty about options is that you know your worst case scenario on day one. And that basically means that I know how much it's going to cost me to buy the insurance, and I know the worst rate that I'm going to achieve. So taking the example that I gave you there a second ago, if I'm buying my option at 88 pence, that I know that if sterling goes to 90 or 93 or 95 and I'm selling sterling, I'm guaranteed 88p. The difference between an option and a forward is that if sterling strengthens and goes to 85p, I can actually sell my sterling at 85p. And the option lapses. The insurance is not required because the adverse effect, or the adverse event, i.e. sterling weakening, has not happened. So the big advantage over an option, for an option versus a forward, is that it protects me against things going wrong, but it allows me to participate if things go well. And in return for that, I pay a premium. There are, just getting into the jargon a little bit more, a currency cylinder basically is creating a range within which the currency can move. So what we're basically saying is, let's say we have a spot rate of 88, and we're going to say, look, we're happy, we want to protect ourselves at 90p. We don't want it to get any worse than 90p. 90p is our pain threshold. And on the other hand, that will cost us a certain amount of money because that gives us unlimited potential. If sterling goes back to 80p, we get the benefit of it. Now say we said, look, the cost of the option is a little bit pricey. What can I do to reduce the cost of the insurance or cost of the premium? Well, what I can do is I can give up some of my upside. So taking my example here, if I have a spot rate of 88p, I want to protect against 90p this side. What I can do is I could create a range within which this can move of, let's say, 86 to 90p. And what that means is that that will cost me an awful lot less because I'm giving up some upside. So in that scenario, what it means is that I will be, if the exchange rate is anywhere between 86 and 90p, that's the rate at which I use. If I'm selling sterling and the rate goes below 86, I don't get the benefit below 86. Equally, if the rate rises above 90, I don't have the cost above 90. So it creates literally this range or cylinder within which it works. And it is possible to structure that as what we call a zero cost cylinder here, which means that we can set it up in such a way that we pay nothing for it, but it has a defined range. So what that really does ultimately is it protects us against a worst scenario. It doesn't allow us to benefit beyond a certain level, and it allows it to move within that range. So it has certain values from time to time. So as I said, what they really do is they allow you to float within a defined range. They tend to be structured as zero cost, but they can be structured in different ways to give you more upside potential if you want. Sometimes what people do is they use these out-of-the-money options for what I call catastrophe insurance. In other words, they don't think things are going to go wrong, but they really don't want things if the currency, let's say we had a mad example of sterling just having another day at 93, 94, 95p, and we just can't survive with that. We might be deciding that, look, we'll buy insurance at 90, 91p. So that rate is a couple of pence away from where the spot rate is today, but that's our pain threshold that we want to protect against that. So we can, there are various ways and means to use these, but as I've said already, you need to get into these in more detail and you need to get some independent advice if you're interested in using these, because they are a little bit more complex, but I think they're worthwhile learning a little bit more about. If we move on then to participating forwards, this is a kind of a mix of the forward and the option. So if you recall, I said the downside to using a forward contract is that while it protects us against things going poorly, we get no benefit if sterling was to move in our favour. What a participating forward does is it guarantees still our worst case scenario, but it allows us a percentage of the upside should the currency move in our favour. However, as with all these things, there is a cost, because in effect what you have here is you have a forward contract protected here at this side, and you have an element of an option giving you some upside here. And as we said already, an option has a cost because it's insurance premium. So what happens is that the guaranteed rate that they give you is slightly worse than the forward rate available in the market. So taking an example of 88p again, if we're saying the spot rate is 88p on the 1st of November, the forward rate to the 1st of December is 88.10. The participating forward rate they might give us might be 88.30 or 88.40. In other words, it's worse than the forward rate we can secure today, but that marginal, that little bit of cost gives us 10 or 15 or 20% of the upside should sterling move back to 85, 86 pence. But I guess the key thing in this space is that there are no free lunches. So to summarize things in this space, I have 4 different criteria set here on the left-hand side, and then I have, against that, set out the different options or techniques, sorry, I should say, that we can cover off here. So what's your appetite for certainty? Do you want unlimited or limited upside? And what's the cost? And that there basically is just a matrix covering the different techniques that I have gone through over the last few minutes. So hopefully that's self-explanatory. Now, if we move on to the areas of foreign exchange impact, we're going to look at the impact on sales and purchases, on margins, in particular gross margins. What are the accounting implications? What are the implications for financial covenants? So in other words, you have borrowings in the bank. There are terms and conditions, financial terms and conditions or ratios that you need to comply with. How could foreign exchange impact on those? How may it impact on working capital and your debtors and creditors control? And also a possibility maybe of an impact on pensions. So this first table here is, what I'm trying to get across here is I've taken a company that's selling £1 million sterling every year from 2013 up to 2017. And they're achieving the average interest or exchange rate for each year. So the average rate in 2013 was almost 85p. That dropped to just over 80 and a half in 2014, 72p or thereabouts in 2015. So we'd strengthened sterling for 2 years. It then weakened for the following 2 years. The third column here, which is headlined Euro EUR, that shows the euro equivalent that we would have received for our £1 million sterling sales, or purchases indeed every year, but I said I've done this from the point of view of sales and how the exchange rate literally impacts on it. So £1 million sterling in 2013 was worth 1.177 million euros. In 2014, if we sold £1 million sterling again, we now would have received 1.24 million euros, which is an increase in our receipts of 62,793 euros just because the exchange rate moved. You didn't do anything different, but because sterling got stronger, your 1 million sterling sales were now worth an extra almost 63,000. And that is profit, by the way. That's straight to the bottom line. So unless you have sterling costs, your profits are up to 63,000. You moved to 2015, the exchange rate strengthened again. Now £1 million sterling sales was worth 1.376 million euros in 2015, which meant you generated an extra 136,000 profits in 2015 over 2014. And in total, your profits now over those 2 years were now almost 200,000 higher because the exchange rate had actually moved in your favour. It got turned on its head then in 2016. Sterling weakened and the average went from 0.7263 to 0.8192. That had the effect of reducing the euro value of our sterling sales back to 1.22 million, which was a reversal of 156,000 euros. And the same has happened in 2017. So I guess there's 2 things to note from this if you look at it in detail. The first thing is that all of the cumulative gains that you would have had in 2014 and 2015 from a strong sterling have been completely eradicated by 2017. In actual fact, on a cumulative basis over the 4 years, you're now 78,000 euros worse off if you're selling £1 million sterling a year at the average exchange rates. And I suppose the second thing I'm trying to get across here is the impact on your profits of unhedged currencies, because you get this volatility. And as I said, you can get a big pickup, but you can also get a big hit to your profits depending on which way the currency moves. And as I said to you, the real key thing to remember here is that if you have no sterling costs, the effect of the exchange rate on your sales coming back into euros flows straight to the bottom line. It has a big impact on your margins, and the margin effect is what's in the last column there. If you move on to the next heading, and it's similar type concept, but what I'm trying to get across here is the impact on your margins. So what I have here on the left-hand column is gross margins of companies going from 20% down to 35%. And then across the top, what I have is an FX movement, a foreign exchange movement of 1%, 2%, 3%, 4%, 5%, and 6%. So the reason why I put this together is because sometimes when you talk about currency and currency moves, it's lost on some people. They're thinking sales the whole time. So what I've done is I've converted the currency movements here into the effect it might have on sales. So basically, if we take the first yellow box there, which is 10%, and what I'm saying there basically is that if you have a gross margin as low as 20% on your sales, and the currency moves by 2% against you, in other words, you get 2% less income, income stroke profit on the translation of your sales, you have to increase your sales by 10% to counteract the lost profit of the adverse movement. Because think about it, if sterling has moved down by 2%, your profits are now lower because your sterling sales are worth less in euros. And if you want to make the same level of profit as you did the previous year, you're now going to have to sell more at that lower exchange rate to compensate for your profits. And I guess what I've done here is anything that's a move of 10% or more in your sales is highlighted in yellow. And the thrust of this really is that you have to increase your sales quite significantly to make up for the lost profits for an adverse move in currency, if that arises. And I guess the other problem you will have in this scenario is that if the exchange rate is weakening because the UK is not doing so well, the probability of you being able to increase your sales by 10, 15, 20% in a slowing economy is very, very low. In fact, it could even be non-existent. So this is really just trying to translate to you the effect on your sales of the profit effect on your sales of adverse currency movements. And I suppose the last thing I would say about this one is that the tighter your gross margins, the more important this becomes, because you can see the adverse effect on sales just kicks in more quickly the whole time. If we move on then to foreign financial covenants, this could be, I think, the area that might be the catalyst for bank pressure. So where this applies is where a company has borrowings from a bank. A bank in turn then sets financial ratios that it says you must comply with so that they know that you're on track with your forecasts, and these are known as financial covenants. So a difference in the euro-sterling mix, for example, of your debt, of your EBITDA, which is your earnings before interest, tax, depreciation and amortization. What that is basically is your cash profits before interest and tax and your interest. If you have a different in the mix, it could have an effect. Because the first thing you got to remember, these are accounting concepts. And if we look at the box underneath here, all of these potentially are impacted by foreign exchange, all these different variables. The first covenant is your net debt to EBITDA. Net debt to EBITDA is your gross debt minus the cash, and that's divided by your EBITDA for a year. All of those can be impacted on foreign exchange. But if you notice here, the cash and the debt are stated at the closing rate for each year, but the profits are always included in your accounts at an average rate for each year. And that could cause quite a lot of change, because you could have a very stable exchange rate for most of the year, and you could get to the end of the year where suddenly there's a very big spike or a very big drop in the exchange rate. That big spike or drop will impact on the debt and cash at year end, because they're at the year end rate, whereas that won't impact on the profits the same way because they recorded at an average, and therefore it's smoothing more. Interest cover is the ratio of your cash profits before interest and tax, or EBITDA, to interest. Both of those can be impacted by foreign exchange, but at least both of them are at an average rate, so you've got some level of comparability. And most banking agreements will also have what they call a capital expenditure, a CapEx covenant, and that's an absolute amount. But again, if you're buying some of your stuff in sterling and some of it in euros, it could be impacted upon by different exchange rates. So again, the difference in mix between your sterling cash versus sterling debt, or euro cash and sterling debt, and the mix of your profits in the UK and Ireland could have an impact here. So it's something that you need to address, and the way you address it really is, excuse me, you run sensitivities. You run sensitivity analysis. What happens if sterling goes to 80, if it goes to 90, how are these impacted upon? So moving on then to working capital. The big pressure in this space is on the adverse effect of higher interest rates in the UK. Now you may recall that the UK Bank of England increased their interest rates by about 0.25% quite recently. The knock-on effect of that, potentially, is that when rates rise, banks begin to tighten their facilities and tighten the amount that they lend to people. So if you have customers, for example, in the UK that use overdrafts, they may find that their overdrafts now get tightened up and get squeezed. So in other words, somebody that might have a 100,000 overdraft, when they come to renew them at the end of this year or whenever they're due, they suddenly find the bank only wants to give them an overdraft for 75 or 80,000. Now, what does that mean? Well, I mean, it's that if their overdraft gets squeezed, they don't have as much to play around with. And the consequence of that, really, more likely, is that they'll slow down paying their customers. And obviously, because you're selling to them, you're their customer. So there is a risk that what they do is they take longer to pay you. They have longer credit terms. So that's the first problem that you may have. Suddenly you may find that instead of them paying you every 30 days, they pay you every 35 or 40 days. And of course, if you don't get paid on time, that has a knock-on effect for your business as well. The second thing you also need to be aware of is that when interest rates begin to rise, it also means disposable income of customers begins to get squeezed. Because again, if you think about it, an awful lot of mortgages are on a variable rate. So if interest rates begin to rise, people's mortgage payments increase, and unless their salaries increase at the same time, the amount that they have to spend decreases. And then that in turn would affect consumer demand, and that in turn would affect sales. So you could have a double whammy here. You could have a slowdown in sales, and you could also have a build-up in your working capital. So what I would say is that you need to keep an eye on what this may mean for you in terms of if your UK customers took 5 days or 10 days longer to pay you, how much extra of an overdraft might you need? The other thing that you need to think about is that apart from the slowing economy, is that the UK banks are now been split between retail banks and investment banks. And the reason why that's happening is that after the crisis, there was a danger that the investment banking, which is a higher risk part of a bank, could have brought down the retail banking, which is lending to us as SMEs and as customers, ordinary retailers, mortgages and stuff like that. They're splitting them now, and that could lead to tighter UK lending because they've now got separate banks for one and the other. And I suppose when these things are new, there's always a risk that the newly set up retail bank might just be a little bit tighter in terms of its lending. In the run up to the trigger date for of Article 50, which is March 2019, you also have to consider, might there be a requirement for increased UK stock levels? In other words, some of your customers might want you to stock up a little bit more, particularly if you have longer life goods. Why? Because if tariffs come in at the 31st or at the end of March 2019, if you've sold them goods prior to that date, they'll be tariff free. Now, of course, if you're stocking up more, A, you're taking a higher credit risk, and B, it's costing you more to invest in that stock. So you've got to watch that as well. And I guess the other point where you might have a knock-on in stocks is that if you have slower customs and a slower process for actually getting things through borders, that may in turn require higher levels of stock because of the slowdown in the supply chain. And again, if you have higher levels of stock, so you have higher levels of credit risk, and you also have to produce more, so you have more cash tied up in working capital. So be mindful of that. So to put this in numbers, let's assume we've got a company that's selling £1 million sterling a year into the UK. There's a current exchange rate of 85 pence, and on average it takes 30 days for its customers to pay it. In that case, the average balance of their sterling debtors will be about 82,000 sterling. If those customers then decided to slow down and they pay 35 days rather than 30, the average balance of sterling debtors increases from just over 82,000 sterling to almost 96,000 sterling, which is an increase of over 13,500 sterling, which at today's exchange rate then equates to 16,000 euros. So to put it in a nutshell, if you're selling on average, or for every 1 million sterling sales per year that you're selling into the UK, every 5 days increase in your debtors balance means that you're going to have an increase of 16,000 euros in your own debtors. And that means there's a slowdown in payments, but also it means that you now have got a larger debtor balance which you need to finance, which puts an extra 16,000 euros pressure on your overdrafts for every 5 days. Should they obviously slow down by 10 days, it's a 32,000 increase, and so on and so forth. So very important to run sensitivity analysis in this space and understand the impact of a slowdown in payments on your cash flows. Now, if we move on to foreign exchange ranges and their impact on finances, what we're trying to get at here is the impact of mainly adverse moves in foreign exchange rates on key variables like sales, profits, interest, and your debt or cash. And we look at the adverse ones because a favourable move in currencies really just means we're getting on better than we expected. Our sales are higher, our profits are higher. So we don't worry about those too much. So the first thing I would say is that the range that you apply should be correlated to the period that you're covering. So let me give an example. On average, for most of the part over the last 10 years, the annual range in euro sterling would have been about 10%. In other words, if we took the 1st of January to the 31st of December for any particular year, the peak to trough, the high to low in that 12-month period would be about 10%. Now, we had an exception obviously in 2016, we had an exception in 28 as well. But on average, that would be it. So if you had a 6-month period to cover, that's what you're worried about, you might only have a range of 5 or 6 or 7%. So the first thing to say is make sure that the period that you're looking at running sensitivity analysis for correlates then with the range, or vice versa. The range is appropriate for that period. It must be fed into your full profit and loss and cash flow then to put them in context. So what you're trying to say is, I'm running my budgets at this time of the year, say in November, December. I'm using an exchange rate of 87p. So what happens if the rate averages 90p next year? What does that do to my sales? What does it do to my costs? What does it do to my interest? What does it do to my cash? One of the things we might try to assess in this space then is, what's my break-even level? In other words, if we run all these figures through a cash flow, which can be done, by the way, in Excel, so they're pretty easy to set up. Is there a rate, an exchange rate at which my profits or my sales to the UK get wiped out? What is that break-even level? You may bring it down a layer further and sort of say, well, look at, because remember, we have two types of costs. We have variable costs and we have fixed costs. We could probably sustain maybe loss-making sales up to a point. In other words, we're more than covering our sterling costs, our variable costs in this. It's contributing towards the fixed costs. We could sustain that for a while. So again, you'll be asking, well, what is that marginal profit level? What's the exchange rate that applies to that? And how long can the business either sustain that? So I guess what we're really looking at here is doomsday scenarios. Sterling gets a lot worse. What's the range, the rate at which it gets a lot worse that causes us a problem? And how long could we sustain those losses or those problems? Because again, it's very important from the point of view of planning cash flows and strategic planning. The other thing I would say to look at is sensitivity analysis on foreign currencies. And in general, I would say to you that Irish companies are particularly poor at reporting in this space. So what I would say is make this part of your process of weekly, monthly, quarterly reporting. I think quarterly is not regular enough. I prefer to see it happening monthly, at least monthly. And decide then on the sources. So in other words, what we're sort of saying is we're projecting forward, we're looking at our sales for our purchases for the next 3, 6, 9, 12 months. You decide on what the period is. First question you ask is, what's the source of the data? So in other words, is finance doing all this, or should the sales data come from the salespeople, which I personally think it should? The next question you ask is, what's the format of the data submission? In other words, are they sending it in an Excel sheet? What are they sending it? What sort of details are they giving us? Are they giving us sales just in total? Are they giving us sales by customer, sales by product, sales by geography within the UK? Decide on that. Then decide on the frequency of the data submission. Is this something we get once a week from them, once a month? But make sure that it's relevant again. Who's responsible for collating that data and reporting or generating the reports? So in other words, we get the sales data in from the sales function. Somebody needs to put that into a report, verify it, and then we have our report there. Who do we actually distribute that report to, and what does it tell us? I would also suggest that you have trigger events or amounts that require an infrequent update. So we might say, look, we'll do these forecasts once a month, we'll update them once a month. However, should the sales go up or down by an amount, let's say 50,000, in the intervening month, we update them automatically. So in other words, changes of 10, 20, 30 grand in forecasts, we won't worry about too much because they're relatively speaking low, but there should be amount of which we say, if they change by more than that, we need to feed that into our forecast straight away because that's a material amount and it may require us taking different actions. Finally, you have to decide on who you circulate the list to, because that's equally important. You've generated the information, who's going to get it and use it. And lastly, it should really, I suppose, stimulate action points. Again, if it's going to be worthwhile information, it should be saying to you, we need to hedge more, we need to hedge less, we need to change how we're forecasting, whatever. But the point is there should be action points coming out of it. So, in summary, what I would say to you is that in this area, as the first kick-off here, You need to be aware of the various hedging techniques. You need to be able to match the techniques to the underlying commercial risks, and that's very important. You don't try and put a product, try and fit a commercial problem into a product. You have a commercial risk and you try and then hedge and put something around it that reduces the financial risks of those sales. But it's important that the techniques match in with the underlying commercial risk. Documentation in this space is a bit of a pain to do, but you have to do it. As I said, it's an administrative burden, but it's necessary. So my advice really in the area of documentation for currency is just get it done straight away. You'll need a dealing mandate that authorises people in the company to deal. The bank will want that as well. You'll need it from a control perspective. If you want to hedge forward, you'll need what they call a foreign exchange hedging line. Again, that basically means that the bank will allow you to hedge X amount of currency for Y amount of months. That will have to be agreed with in advance. And by the way, the bank will go through a process in this space which will be the very same as making a loan application. So if you want to be able to hedge, let's say, up to £500,000 for up to 12 months, you've got to tell them that you want to do it. They've got to approve that internally, write to you and say you've now got a hedging line that will allow you to do £500,000 for 12 months. And that has to be done first, because they won't transact with you now without that in place. As foreign exchange moves flow straight to the bottom line, you need to prioritise it. And I said we've shown that, I think, particularly on the sales and the gross margin slides, which we looked at earlier on. And I said, watch the impact of foreign exchange moves and Brexit on banking. So both, that's where your bank is your lender, and in the widening banking industry attitude to risk. So particularly, as I said, I would have a concern about the slowing payments by customers if banking gets tight. But also do remember that if their economy begins to slow down in the UK, disposable income is likely to get squeezed, and in that scenario your sales could come under a little bit more pressure. So you've got to be alert to that sort of stuff. And last thing is that be very, very careful where material foreign exchange exposures and financial covenants exist in banking agreements. If you have a lot of your sales in the UK or a lot of your purchases from the UK, therefore your cash flows are highly exposed, and you have borrowings, you're just going to be that little bit more susceptible to adverse things happening in your financial ratios. So in that scenario, one, it's very important to understand how foreign currency impacts on those financial ratios, those financial covenants. And secondly, I guess, understanding that, what are the things you need to do to mitigate those risks so that it doesn't become a problem. So that's the end of our first currency workshop. And in the next one, we move on to dealing with strategies and policies.